Bill Baruch, and I'm here with my partner Oliver Sloup, and we're the co-founders of Blue Line Futures, and we're bringing you a new segment, Trade It or Fade It, where we're going to talk about some trades on our radar and potentially build into something actionable. So we're going to start off today. I think you're looking at corn right now?
Yeah, looking at corn. I love using seasonals as a way to help generate ideas. We had a bearish corn seasonal kick off at the end of April. It's for the September contract, starts April 30th, goes all the way through June 24th. So a little bit of duration on that one. And it is a bearish seasonal. But if you look at corn and where it's traded over the last 2 weeks, we're 60 cents off those recent highs. The daily RSI is at 20. So we're deeply oversold over the last 2 weeks already at the very beginning of a seasonal. So I don't necessarily like this trade. I'm going to toss this one here, but I'm going to keep an eye on it. If we get a relief rally, I would be looking to use that as a selling opportunity to kind of leg into this bearish seasonal. Now, I know there are some more appealing seasonals kind of on the horizon in the energy space. That's kind of more along the lines of your markets. Why don't you tell us what you're looking at there?
Yeah, great. I agree with you on the corn. I'm with you. It's you don't want to be selling in the hole down here. And I'm looking at gasoline. You got a gasoline seasonal coming up that begins May 8th, and it goes all the way in through July 3rd, right before Independence Day, playing a little bit of that seasonality in the driving season, summer driving season, kids getting out of school, people traveling. This has made money 12 out of the last 15 years. Now, crude oil, it's a bloodbath out there today. It's approaching $70 in the front month contract. I think there could be some more downside here in the near term, but this builds into a great opportunity potentially for that May 8th seasonal in gasoline. I mean, there's a lot setting up here right now. I mean, we've had some energy companies report earnings over the last week, and they're talking about refining output, refining capacity picking up, and that's something that's probably driving the market a little bit lower. That coupled with the Chinese manufacturing data, which contracted as a surprise over the weekend. So coming out of the weekend, that weighed on crude oil. Remember, crude had a really great close on Friday,
right.
And it choked it up pretty quickly. I don't think that China is going to just kind of continue to dissipate in growth. I think we're going to see actually a big growth impulse in China over the summer. So I think that's something to really lean in. I mean, we've seen new loans data in April was the highest since second highest on record behind January. We've also seen some really tremendous output. What was it? 22.5% crude oil increase year over year for crude oil imports by China. They're ramping up for this reopening trade that's basically happening, because the reopening really hasn't happened yet. So I think there's a lot of ways to play it. What do you think about this?
Well, I love it. As you mentioned, a bloodbath in the energy space today. We've got, looking at RBOB down 4.5%, crude oil down 5%, just a stone's throw away from that psychologically significant $70 levels, and kind of reverting back to what I mentioned from the get-go, using these seasonals as a tool to generate an idea. So you've got the seasonal aspect coming into play here in the next week. You said it started May 8th.
Yep.
Technically, I think you're at the lower end of the trading range when you're looking at crude oil. If you're going to parlay that seasonal and RBOB into just the energy space and crude oil, 65 to 70, that seems to be a pretty good floor in the market, knock on wood. You've seen the administration step in and say that they're willing to refill, or at least talk about refilling the SPR at those levels. And the China growth story, I think, is very under talked about. So I love the aspect. You got the seasonal, the technicals, and the fundamentals coming into play, the trifecta.
And Brent's in the 70s now. And OPEC Plus, I mean, they've been cutting production in order to really defend these levels in Brent. And so I think that's something that it's always in maybe the back of our minds,
right,
is that you get a nice crude rip. We saw that about a month ago. And man, who knows where crude would have been if they didn't cut production. But I think that's a narrative that could continue to underpin it going forward. So one of the ways I'm looking at it is management risk in this volatility is using an option play. Now, the CVol, it's a tool on the CME's website, talks about the volatility. You don't want to pay too much for volatility. So put this in perspective, CVol on crude oil. So I would play this with crude oil, actually, because options of crude oil have a lot more liquidity. And then to talk about some of the refining capacity could help crude oil outperform gasoline, potentially what you're hearing from these energy companies and ramping refining capacity up a little bit. So I think crude oil CVol at 41 here today. It's off the highs in March, peaked in March at 53. But put that in perspective, it was at 100, almost at 100 in March of 2022 on the onset of that war. So I think that is nice, maybe kind of a little bit of high volatility today at an uptick. But we're going to wait on this to see maybe a little better price to be buying it. So the volatility is low. Now, managed money, which is the large traders,
Right.
CTAs, hedge funds, they have actually sold a little bit of crude as of last Tuesday. So the managed
It's
money
off the Commitment Traders report, right?
yeah, all the commitment traders report can be found on the CME's website, and that's 10%. About 10% of that managed money position has been shed since as of the end of last Tuesday. And I wouldn't be surprised. I mean, to see a $10 move lower here in the last week, basically, or $7 in crude oil, so 10%. You're probably more selling here. So
Exactly.
I think this gets you to a space where managed money's not over positioned. They're actually under positioned, and that could be a tailwind to this. So kind of playing all that lining up, I think the way to look at it is a August call spread. So August would expire in the middle of July, and that would get you through that July 3rd seasonal, and using a 78.81 call spread. Right now, today's trading about 77 cents. I would be patient, wait for this thing to come down to about 60 cents or so. You got a little bit of time. That's where I would find some good value, and I see myself acting at that level.
Yeah, I love using the options as a way to get that market exposure. It limits the risk, and going out to the August, that gives you 76 days. That's a lot of time. So it's not one of those things where you have to be right now. Your back's not up against the wall. You have some time for this to play out. So I really like that aspect of it.
Yeah, and the other thing, too, is if crude oil rebounds here, since the September through October selling, that August contract has pinged $80 every month. So, I think we'll find it back to $80 at some point between now and that expiration, and that gets you right in the money. That's where you want to be.
Love it. Great trade setup there.
Yeah, this is the new segment, Trade It or Fade It, and it's up to you. Thanks for joining.